Hello and welcome to Investing Confidential. Is the market going up? Is it going down? Nobody knows. Okay, the last few weeks we've been jockeying, actually trending higher, but really moving down, moving down, moving up, moving down. You got professional investors selling good news. Okay, that's all they're doing right now. You got earnings coming out; they're not very good, and a lot of people are getting very bearish because of the recession, impending recession. We're in the recession, but let's not get into that. And then there are other people getting bullish, saying people are too bearish. So I'm going to look at both sides of the trade right now and let you know where things stand, and also show you one slide towards the end that I think is going to be very telling that nobody's talking about. Okay, first let's talk about why people are bullish. Okay, the big chart that's been out there is from the Bank of America survey. Investors are very negative. They're the most underweight stocks since 2009, as you can see here. What is the Bank of America survey? Everyone quotes it. Okay, Bank of America survey is something I've been participating since its beginning. It started in the 2000s. Okay, I was a participant, and you get once every few weeks you get this survey and you fill it out. It asks you for your opinion on different sectors, on countries, macro, all of this. You fill it out, it goes to Merrill Lynch, and boom, they come out with this survey. And what the survey basically do is they tried to tell it basically says if people are leaning one way, you should go the other way. That's how they look at things. Okay. It's a little flawed because I think a lot of the people who are very enthusiastic and really took it seriously are no longer in the business. And now you got young people who don't really care. And so I would think that if Bank of America released how many people are actually participating in the survey, it's much less than before. Okay, with that said, investors are very negative, which is bullish. There you go. Okay, second reason people are getting bullish, China. Okay, China's GDP was up over 4%, very strong versus the expectations. Not great, obviously, versus the past, but better than expected. Why? Okay, it's very easy. China has been stimulating. Okay, they don't do like they don't sit back like us. No, they come out and they force the banks. The banks are all controlled by the government to lend like crazy. And that's what they do. They throw a lot of bank loans around, especially towards the real estate sector and exports. And obviously, here are the results. Okay. The real estate sector, home prices are finally rising. Okay. We spoke about this, that this was a possibility. It's now happening. All property in general is rising. This is very positive for the Chinese consumer. So look what's happened. Luxury goods, okay? The consumer confidence better, and look at the luxury goods that are being purchased is spiking. This is a direct result of China. Chinese love luxury goods. When the consumers feel good, they spike. And this has been very good for the French market. The French equity market is outperforming the rest of Europe because there's a lot of large luxury goods like LVMH that are in the index. So French stocks are moving, luxury goods are going higher, all related to China. Then you've got exports, throwing things out there, and their exports are very strong, especially autos. By the way, Chinese are selling outside the US, obviously. Chinese are dumping EV autos and all kinds of autos all over the world. I can tell you that right now. I just came back, as you guys know, from Chile and some other countries in Argentina, et cetera. There are Chinese autos everywhere. Okay. They're dumping their autos all over the place. And this is obviously positive. But then again, I always have to give a negative. There are still issues with China. Okay. This much hyped Belt and Road Initiative basically has fallen apart. I spoke about this a number of videos ago. This thing's gone. This was a very hyped, all the US press hyped it. China's going to take over the world, Belt and Road. Garbage. It's gone. They lent all this money. They did lend a lot of money, hundreds of billions of dollars, and they've all been defaulted on. Okay. They lent money to unfortunately, developing countries in Asia, Africa, Latin America, and China has lost billions. Okay. And they're going to lose more because they have to lend more money to see if they can get back their money. And who are they lending to? Deadbeats like Venezuela and Ecuador. Okay. They've already defaulted on hundreds of millions. They will continue to default on loans. And what is China going to do? They can't do anything. Can't do anything. So, yeah, China's growing. It's bouncing back, but not like the past. Okay, it's going to be muted because of all the losses they had. Their banks are decimated, but the government controls everything, and things are moving. And what does this do? Gives a boost to the overall global economy, especially the commodity sector. And, folks, yes, When you have commodities moving, it is globally inflationary. So good news for China is bad news for the US and anyone else who's trying to contain inflation. Okay, so I just spoke about the good news because that's really the good news people are banking on. And let's talk about the bad news, because at the end of the day, stocks move on earnings expectations. And what you're seeing today, the last few actions since the earnings started, is earnings are not good. I showed a chart of last week how there's more negative growth, negative expectations and positive expectations for the future earnings. Okay, companies are saying, "Hey, here's my outlook. It's not good." More companies are being negative than positive, and these expectations are declining fast. Okay, look at 2023 earnings expectations versus history. Okay, collapsed. Okay, this is what we're seeing. Stocks cannot move significantly higher. They can rally, have bear rallies, but they can't move higher with this in this type of scenario. Then you've got U.S. bankruptcies. They're exploding, folks, versus the last decade. I mean, look at year to date versus the last year to date. This time going back 10 years. Okay, this year could be a record of U.S. bankruptcies. I mean, how is that good? Okay, not good for banks, not good for small business. And now we're talking about banks. Let's talk about this bank fiasco that we're going on and the implications for the real estate market, because they're linked. Okay, banks, look at this. Banks still aren't hedging against future rate rises. They think it's over. Okay, this is not good. Okay, they haven't learned any lessons. Okay, they must be listening to Yellen or the White House, because other than that, there's no reason why at this point you wouldn't hedge some of your portfolio for future rate rises, but they're not. But now they have a bigger problem. Banks are now going to have to start ramping up their deposit rates. Okay, money markets, as we shown last video, are taking a lot of money. Money market assets are exploding because of the rates they offer. And this money, again, banks do not make money off money markets. So boom, they've got to raise rates on deposits to offset. And what is the result of this? Lower net interest margins. Okay, the difference between what they have to pay out and what they get from their investments, that's net interest margin. When net interest margins contract, this is very bad for earnings. So, and then, the banks have decided also they're not going to lend. Okay, credit's being pulled back. The consumer's over levered. So the consumer's crushed. No more lending. You're not going to get the credit. You're not going to get these credit cards thrown at you in the mail. Okay, small businesses, when they need it the most, the banks are pulling back. This is very, very bad for the economy. And then we have the real estate market, which we've talked about in infinitum, and it just continues to get worse and worse. Look at the change of real estate lending over the last 12 months. I mean, over the different parts of lending. Commercial, gone. Okay, but even lending, this is interesting, even lending to apartments has collapsed. Okay, look at multifamily lending. It's crushed. Okay, but yet here we have units under construction at all-time highs. It makes no sense, but they need more money to complete these units, and they're not going to get it. So what's going to happen is you're going to have a lot of just empty multifamily units laying around. Okay, and why is all this happening? Rents in the U.S. are trending down for the first time in many years. Okay, this is the beginning of a multi-year event that's not going to stop. Okay, rents are going lower. This is good for the economy, but again, overall, it's bad for real estate. The home builder sentiment, as you can see, are very bad. Okay, prices are reducing. Home building stocks rallied over the last couple of days on backward-looking comments. Okay, building permits are lower. This is the result of all this, and there's no reason to be buying home building stocks here. Okay, the sentiment's very bad, and look at the effect on retail sales related to housing. Look at this. I mean, it's just a disaster. Okay, Home Depot, look out. Any retailer that gets their money based on people upgrading and sales related to housing, I mean, it's gone. Lumber yards, all these guys, I mean, they're going to suffer. Okay, and it's not going to get any better. And here's the kicker: global real estate versus other assets in terms of value. Residential homes, okay, the residential home value, overall values, have never been overvalued in history. Okay, this is a pandemic effect. Never been. It's not going to stay that way, folks. It's not going to stay that way. Real estate prices are going to come significantly lower. And finally, as I mentioned at the beginning of the video, here's the biggest risk of all, okay? That nobody's talking about except me. I have here you're going to see I have a video on this I did a number of weeks ago. This is Japan, okay? What has happened, we have a shot across the bow. Japan insurance companies are taking their money out of the US in euros, but mainly in the US, and bringing it back home. Basically because the rate they get from a hedged US bond, okay, because they have to hedge the US bond, is much lower than the 50 basis points or 70 basis points they expect from a 10-year Japanese bond. Okay, it sounds nuts, but that's the reality. So Japanese financial institutions are now selling out of US assets and bringing money back home. This thesis that we talked about a month ago or so is playing out. Okay, this is bad for the dollar. It's bad for interest rates in the U.S. because if you have a big bond seller, that means the rates. Okay, when prices go down, rates go up. The rates in U.S. bonds are not going to go down. Okay, that means that's going to affect mortgage rates, et cetera, et cetera. And then, why do you think Warren Buffett was buying Japan? Why do you think he came out and put more money in Japan than he is in the US? He's not a fool, even though he's old. He sees what's happening. He's a smart dude, and he invests for the long term. Why does he see this going on? Because he thinks this is a multi-year event. The Japanese yen is undervalued. The Japanese economy is going to start to inflate. You're going to see this barrier of 50 basis points erupt towards 100 basis points. This is why they're bringing money back home, and this is why it's not good for the U.S. So a little bit of good news for the U.S. Again, these bear market rallies will continue, but eventually the you-know-what's going to hit the fan, and we're going to get another whoosh, okay? So if you're an investor, be careful out there.